All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have the founder of Net Interest, Marc Rubinstein. Marc, how are you doing?
I'm all right, Andrew. Thanks. It's great to be on.
Great. Well, hey, thank you so much for coming on the pod. And let me start this pod the way I do every podcast, and that's by plugging you. I'd say everyone I've had on here so far, you're the person who I was, as of like 2 or 3 months ago, the person I was least familiar with. You started publishing Net Interest, I think, was it March or April? And the moment you started publishing, a couple of my friends who I really respect were like, you need to read this. This is going to be must read. It's going to make you a lot smarter. So I subscribed and they were 100% right. It's about once every other week, I'd say. Once a week, once every other week. And it covers the financial sector. And what I really love about it is it's not just the hottest topics of the financial sector of the day. I love kind of the financial history you bring. So like one example I was kind of thinking of when I was prepping for this is you did a cautionary tale of equity research that went through all of the history of equity research through the 60s and 70s and had a bunch of anecdotes from the late 90s, early 2000s with Elliot Spitzer cracking down. And, that's just something, it takes a lot of industry knowledge, a lot of expertise. It's really interesting to anyone. So I've really loved Net Interest. That plug out the way, can you just kind of dive into your background and how you came to start Net Interest?
Well, that's a good segue, Andrew, actually, because if we go back to the genesis of my career, it started in equity research. So I came out of college and I was thrown straight into the equity research department of a major investment bank. And I was thrown into the bank sector. Mm-hmm. So I had no background in banks whatsoever, didn't even know I wanted to do equity research whilst I was at college. But there I was covering European banks at a time before the single currency, where the European markets were a disparate collection of discrete markets. And I did that for 10, 12 years through the Elliot Spitzer period. And then after about 10 years, I switched over to the buy side. So like a lot of equity research, sell side people, I switched over and went to work for my favorite client. So I got a call 2006 from my favorite client, and like a shot, I went straight over there. And this was just before the financial crisis. And it was specifically to run and analyze companies within the financial services sector. So it was a financials focused fund, long short.
Yep.
One of the oldest hedge fund firms in Europe, based in London, which had launched a long short financials fund about a year or so before I joined. So I joined to be part of that. Had about a year before the financial crisis, and then boom, straight into the thick of it. Through the financial crisis, we were long short financial services stocks globally. Did okay. We can talk about that. Did okay during the financial crisis. Came out of it. And as everybody knows, trading financial services stocks wasn't the same post-financial crisis as it was pre or during the financial crisis, although it took us a while to understand that. And so we continued to run the fund through until 2016. In 2016, we liquidated the fund, and I took some time out. I went back to college for a year, which was fun.
Awesome.
I'd never done an MBA, and thought it would be fun to do something like an MBA. So I went back to college for a year to immerse myself in non-financial services oriented parts of the market, and then set up a consulting business. Was doing that right until COVID hit, and then COVID hit. Boom again. Consulting projects dried up. And launched Net Interest. And I've been writing that on a weekly basis. The focus is financial sector themes, and I've just been overwhelmed by the degree to which it's picked up momentum.
Yeah, and one of the other things I like about Net Interest is you say financial sector and financial services, and in my head I think, oh, he's going to be covering JP Morgan and Wells Fargo, and maybe if I'm lucky, he'll get really spicy and cover Visa and MasterCard or something. But, I think you even said in your intro, you said, look, use the Enron quote where somebody said, I cover banks and they can put balance sheets out, but you can't put a balance sheet out with your earnings. And the Enron guy famously called him an asshole for saying that. And you say, look, every company or many companies can be like financial service firms in disguise. And I really like how a lot of what you cover is companies that are financial service firms in disguise, I would say. So let's dive back into the financial crisis. So, you mentioned working for a long short fund in the financial crisis. What was that like? Like, what was your experience like? Because I think a lot of people think, oh, long short service firms, well, 80% of them are blowing up in the financial crisis. That's a time for alpha. But, coming out of the pandemic, I also think it doesn't matter if you're long or short. Like, in a crisis, just everything is straight down. So what was your experiences like there? Take us through some war stories.
Yeah, so I mean, the first point is that it really was a front row seat. So I think, I think one of the reasons why unlike subsequent crises, that crisis started in the financial sector. And it started in the financial sector materially earlier than became evident across the broader market. So, and I would say it started in the financial sector in 2006. So in 2006, I was covering, joined the fund. I inherited a short position in New Century, which was a pure play subprime lender. And I was monitoring the developments in subprime from 2006. And already, in 2006, there was a trend of so-called early payment defaults. And this idea, and partly because I was an outsider, I was sitting in London, I was sitting in an office in Mayfair in London, looking at the subprime industry, not really knowing that much about it. So, the first question that arose was, why would somebody who had just taken out a mortgage default within the first 3 months of having taken out that mortgage? And this trend was going up. So we saw that through 2006 into 2007. Actually, New Century went bust in February 2007. HSBC, which had done this huge acquisition in the US in the subprime space, had a huge profit warning in 2007. So already the beginning of 2007, end of 2006, something clearly was going awry. And I think what gave us an advantage as a financials only fund is that this was happening in the periphery of the financials industry. So we saw it, and we were able to trace it. So by the summer of 2007, it hit Europe. In the summer of 2007, famously, people kind of debate what marks the beginning of the financial crisis, but in the summer of 2007, some of the French-run funds basically had an issue. In the summer of 2007, one of the German banks started to suffer issues, and then by the autumn of 2007, some UK banks were starting to have issues as well. So it was happening. So we were able to draw, but by being global and by being involved in financial services, we were able to draw some of these dots. And that was it was a very fertile area for long short, because at the time there were elements of financial services. You mentioned Visa at the beginning of this chat. Visa went public in March of 2008. We were involved in the IPO. So there was an opportunity to be long, and there was an opportunity to be short. And actually, it was the first. If we roll forward through Lehman, obviously people are more familiar with that period, through into the first quarter of 2009. First quarter of 2009, you had huge dispersion between the brokers, which were recovering already. They were the first in, they were the first out of the crisis. So, Goldman's performance was very, very strong in the first quarter of 2009. Citigroup's was very, very weak. It was kind of last in, last out. Chinese banks, we were long some of those as well, performing very strongly because China was pumping liquidity via the banks into its market. They were performing very strongly. So we had huge dispersion. It was almost a golden era for long short financial services. That changed, and I would say, one of the difficulties in investment is having that awareness to change one's mental models.
Yep.
Mental model that changed, that I was slow to get onto, was regulation.
Yep.
was the impact, and it's a theme we can talk about as well, because it's something I've addressed in net interest, was this idea that regulators were inserting themselves almost into the capital structure of financial services companies, combined with low interest rates, which basically turned banks and financial services broadly, with the exception of some tech-orientated ones, into a macro trade.
Yep.
And that macro trade was, it was all about regulation. It was all about rates. And that dispersion, which long short thrives on, diminished. And, since then, and it's been 10 years plus, we've had a very, very high degree of correlation, even between markets. I mentioned China earlier, but that correlation has gone close to one between China, between US banks, between banks globally, and it's driven by interest rates and it's driven by regulation. And that was a mental model that I was slow to cotton onto, and it cost a little bit of performance kind of in the early part of that financial crisis aftermath.
No, look, I think it's the hardest part about being an investor in anything today, right? Like the example I always use is 40 years ago, it would have been easy enough for you and me to go out and kind of flip through the newspaper and say, oh, here's 10 stocks trading at 6 times price to earnings. We're going to buy all 10, and we could probably expect to outperform the market over time. And today, I would say if you go out and you do it that simply, you're probably going to get your head blown off, because all you're doing is replicating what a quant model could do. And I agree with you. The markets, if you compare the bank regulation market of 2005 to today, it's just apples to oranges. There's no comparison. Let me ask you, we talked about the financial crisis a decent bit. When I look at today, unemployment is around 10%. And I think obviously there's a lot more liquidity in the system thanks to the Fed. But when I look at the unemployment numbers, the uncertainty out there, if you had told me at the start of the year, this is what right now would look like, there's a lot of things I would think that haven't come true. But one of the things I would certainly think is the banks would have blown up, right? Like credit losses would be off the charts. The banks would be reserving, raising equity. Everyone would be freaking out. And when you look at the sector, that's really not what's happening. A lot of the banks still trade at or above tangible book values. They're taking credit losses, but they're fine. But what do you think the difference is between, unemployment today is higher than it was in the financial crisis? What's the difference today than 10 years ago?
Well, there's probably 3 differences. I think one is the banks universally have got more capital now than they had going into the crisis. I mean, it's something they bleat on about all the time. There are still corners of regulatory and policymaker circles that argue they need more capital, but they've just got more capital than they had going into the financial crisis. Second reason is that, and this is interesting because this was an accounting change that was introduced really just in the nick of time. It was the accounting change. It was the CECL accounting change that was introduced just in time almost for COVID. And what it required banks to do, and they did in the first quarter of this year in the US, and there's an equivalent in Europe as well, is to front load provisioning. Interestingly, they had the earnings to front load provisioning because markets businesses, because of volatility, were doing so well.
Yep.
So, this kind of, if regulators got one thing, the one thing I've learned about regulation over the years is that it always has unintended consequences. And typically those unintended consequences can be more onerous and, as an observer, more interesting than the consequences that they're meant to inform. But one thing there was, thinking about Volcker and thinking about ring fencing in the UK, one thing there was a lot of momentum towards was to break up banks into broker dealers or investment banks on the one side and kind of retail banks on the other. And it never happened. Fortuitously, it never happened because the likes of JP Morgan, the likes of Citigroup had huge markets, capital markets orientated revenues to extract in the first quarter that enabled them to shore up their provisioning through CECL ahead of potential economic collapse. And so, that's the second reason, is that they've just provisioned up front to a degree that they weren't able to do 10 years ago. And then the third reason is obviously government, more fiscal intervention. So, just any model, any classical credit card model would have, you say unemployment at 10%, would have had unemployment at 10%, charge-off rates commensurately high. But, what that model wouldn't have factored in is fiscal injections to the extent we've seen globally. And so you've seen just a disconnect in that classical model between unemployment and charge-offs. Now, clearly how long that sustains is an interesting question. That explains why bank valuations are where they are, I guess.
And you mentioned, and I'm going to put you on the spot here. If the answer is no, feel free to say you haven't thought it through fully. But I agree with you when you say regulation can often be quite onerous. But I also think it can present some opportunities that a lot of people aren't thinking of. So, like right now, coming out of COVID, I think the regulations are still a little bit in flux, to be honest with you. But coming out of COVID, are there any regulations with unintended consequences that you're kind of like seeing opportunities in?
Coming out of, it's a really interesting question. Coming out of COVID, I don't know, but a space I've been looking at quite a lot recently, and I've done within that interest a couple of posts, and I did a guest post in Napkin Math as well, which is part of the Everything bundle, also a Substack blog. It is the exchanges. I've been looking very heavily at exchanges, and if there's one subsector that has been the winner, because the other thing, if regulation has unintended consequences, then by the same token, it's not quite zero sum, but for every loser, there's a winner. And I think the winner from the bearing down of regulation on the banks has been and continues to be the exchanges. Whether it's taking LIBOR away from the banks, the exchanges could be a beneficiary of that. Whether it's, just last week we saw there's a whole debate around, and we may go on to talk about SPACs and IPOs and so on. But
we're talking about SPACs.
Good. I've read your post as well, so there's plenty to talk about. But the New York Stock Exchange announced last week that it's going to allow primary direct listings on the exchange. So companies. Actually, there's been a bit of a wrinkle there. The SEC have put a hold on it, but it seems likely that in spite of that, companies will be able to directly list on the new exchange and raise capital. That's basically a shift in the balance of power away from banks, which control the IPO process, to exchanges. There's a whole list of these examples where exchanges are the beneficiaries of these regulations. Coming out of COVID, I don't know. I suspect, people talk about COVID as being the great accelerator. And so, a lot of those trends we'd seen already, be they a shift in the balance of power from banks towards exchanges, could equally be accelerated. It's difficult to discern a specific COVID-related, probably the impact, and certainly in the UK, there's a lot of political backlash. How that impacts the banks, it could be, they say the banks could be the beneficiaries. They say, people have said, the banks themselves have said, this time, unlike last time, we're the solution, not the problem.
Yep.
And if that can be proven, then maybe the pendulum swings back towards them.
Yeah, I do think with banks, I mean, cable companies are obviously a completely different animal, but banks, cable companies, a lot of these really big companies that are traditionally villains of pretty much anyone, a bank after 2008 was an easy punching bag for any politician. A cable company has always been an easy punching bag, but I do think they've bought themselves a lot of goodwill with the banks. They were there for their customers. They stepped up. I think a lot of them kind of avoided really putting the hammer on credit card debt and people who had been affected by COVID. With the cable companies, the reason I mentioned it is they weren't disconnecting people who lost their job and couldn't pay for their internet. And obviously that would have been a disaster if they had. You're basically cutting someone out from the world when they're stuck at home and don't have internet. So I do think they've bought themselves a lot of goodwill. And it's just interesting, like 6 months from now, it's tough to tell how any of this is going to look, right? Like, we don't know what the political environment's going to look like, which is obviously very important for these guys for regulation. We have no idea what type, do we continue with a V economy? Is there a vaccine? Like, it's such a strange time. And I kind of think, like, back to your old days, it's going to be a very fertile time for the type of long, short investing that you used to practice and still obviously follow very closely.
Yeah, I think that's right. And I think there is a bull case to be made for banks. Clearly it's not reflected. I mean, clearly the bear case is winning out, and the bear case revolves around some of the things we've spoken about interest rates and about policymakers kind of inserting themselves in the stack and influencing capital allocation. I mean, when we look, as kind of value investors, capital allocation is a dominant theme. And if a company doesn't have control over its own capital allocation, i.e. cannot decide whether it's M&A, kind of Wells Fargo is cut out of that market historically, or whether it's buybacks or dividends, and the banks are being cut out of that right now. Not having the ability to steer one's own capital allocation strategy, it kind of degrades your position as a shareholder below that of the policymaker, which obviously degrades the overall equity story. But there is a bull case on the other side of that, if we come out of that, which is there's consolidation of market share that's taking place. You look at the influx of deposits into the US banking system and the flow towards the bigger players. It's kind of a feature across most industries, is that the big are getting bigger, and that's true. And that's in spite of regulation wanting to kind of enhance competition in the banking sector. Another theme I write about quite a lot. One of my other hats is as an active angel investor in fintech. And one of the other themes that I write about a lot is fintech. Yeah. And, kind of coming into COVID, there was a view that this would be fintech's time. Fintech, these are the innovators, these are they offer speed, they offer a digital solution, and it just hasn't been the case. I mean, there are some exceptions. Square, but it just hasn't. But broadly, the smaller ones, the startups, some of the challenger banks, of which the UK has been a big testing ground, are struggling.
No, it's actually something I think you wrote about a month and a half ago, right? Like the big banks, I agree with you. Like if you told me coming into COVID, it's like, hey, the big banks have a physical footprint, right? That's closed, and management's going to have to spend time worrying about that closing. The big banks obviously are much higher concern for regulators than all of these legacy guys, and they're going to have way more loans and loan losses than the startups. So if you had told me coming into COVID, and big banks, because they're so bureaucratic, they're probably going to be slower to shift and adapt to technology. So coming into COVID, I would have said, if you're a startup bank, a SoFi or something like this, I would have guessed they were going to see huge share increases. And they, similar to, it's a looser comparison, but similar to Amazon and all these online retailers just pulled tons of share forward because they, all of their physical competitors were closed. I would have guessed all the kind of innovative fintech players were just going to slaughter in this environment. And it doesn't seem to have played out. In fact, the opposite. So could you dive a little bit more into why the big banks have held up so well and maybe even taken share in this environment?
I think partly to the extent that they are quasi arms of government, through the fact that policymakers have inserted themselves in the capital stack, figuratively. The challenge was to get money out there into the economy quickly, and that requires scale. And so, if you look at, and I looked at a number of markets, the UK and the US and a number of the European markets, the authorities were slow to authorize fintechs to disperse, whether it was PPP or the equivalent in Europe and the UK. And the big banks didn't do such a good job necessarily, and there were question marks about the way that was done. But they were there and they were able to do it quickly, and they had the scale to do it quickly. And the same when it comes to deposits. It's kind of they, as I say, and it's not a feature necessarily of the banking system. It's a feature of most industries are seeing. Most industries, there's a great, Michael Mauboussin put out this report on public to private. It's a great report, and I'm sure most of your listeners have,
I actually listened to he did the Invest Like the Best podcast, and I listened to it while I was walking the dog this morning on that. So
exactly. So did I, actually. Also, I was walking the dog this morning and I listened to it. but he talks about the the Herfindahl index that he took one
Yep.
of them he took
HHI.
exactly, and within various industries, and it's just increasing in many industries, and banks are no exception. So for various reasons, there's a kind of a concentration of market share.
Yeah.
And the banks aren't immune to that.
Yeah. For banks, I like last year, we've traditionally looked at a lot of small banks, and recently one of my questions over the past, I'd say 3 years, has been, look, for a bank, like a lot of the stuff, investment into tech and regulation, that scales, right? And a lot of smaller banks, their mobile app was either non-existent or was awful. And, you know, they were used to, hey, we have the bank on the corner, so everybody gives us deposits. And they were losing share hand over fist to Bank of America, Wells Fargo, all these guys. There was even an interesting Wall Street Journal article that had, it was like an employee at a bank was like, yeah, I had to like shift my deposits to Bank of America so I could do mobile checking, right? So it makes sense that the small banks are losers, and you see that in a lot of the small bank share prices, which trade way under book value. And I continue to think there needs to be consolidation there, but I'm still a little surprised that you didn't see, you know, Robinhood has obviously grown trading accounts like crazy, and there's a lot of issues there, but I'm surprised you didn't see like a SoFi or something really break out in this environment. Let me turn to one other bank before we jump into, I really want to talk SPACs with you for a second as well. One of the Wells Fargo you mentioned, right? And I look at Wells Fargo and I see, hey, this trades at 70% of tangible book, whereas JP Morgan trades at 1.7 times. And the regulators aren't going to let them buy back shares. They aren't going to let them grow. They aren't going to let them do M&A. Like, what the heck is the future for Wells Fargo?
It kind of breaks. It's a really interesting question. It kind of breaks the tech. We talk about capital allocation.
Yeah.
And you go through, and you've just highlighted, the textbook uses of capital. And I'm not sure there's a chapter in the textbook for what happens when the regulator actually doesn't allow you to do any of those. So you accumulate capital.
Gone. Yeah.
Clearly, there's a school which embraces the view that retained earnings are shareholder earnings, and that, as a owner of Wells Fargo, you own a piece of Wells Fargo. It's the Buffett school, and at some stage in the future, you will get those earnings back as a shareholder, as a partial owner of the business. But there's not, and in an environment where rates are low, maybe you are prepared to wait a bit longer for that. Notwithstanding the fact that low rates kill the kind of front book part of the business on the deposit side. But I don't know. I don't know. As I say, the textbook, the chapter hasn't been written. The model that I use to kind of describe it is you're a minority shareholder behind the government, and when that happens, shares do trade at a discount.
Yeah.
And those kind of minority discounts can sustain for a long period of time.
Yeah. No, it's an interesting one, right? Because JP Morgan's trading at 1.7 times book, Wells Fargo's at 70%. Regulators seem like they won't let them do anything. But at the same time, I think like 6 or 7 years ago, it reminds me of Bank of America, right around the time when Buffett put in the preferred and the converts and everything. Yeah. And I think the stock's been like, even after all the COVID disruption stuff, I think the stock's up like 4x over that time. And I look at Wells Fargo and I kind of think like, 10 years from now, a lot of this noise will have passed and you'll have bought what's always been one of the preeminent bank franchises in America at 70% of book. It seems like you do well from there, but at the same time, like it just feels like there's something squishy there. I can't quite put my finger on. I'm not sure. Anything else on Wells Fargo or anything here? Or there's 2 newsletters of yours I really want to highlight. I'll switch to, but any last thoughts here?
No, except you mentioned something earlier on about, and it comes through in valuation, which is, another mental model that kind of got broken, which is that, things shouldn't trade at a discount to book if you believe, or even, if we inject some kind of discount because figuratively you're a minority shareholder, so maybe 0.7 a book, but there's a lot of bank stocks in Europe which just crashed way below that. They crashed way below that. And you mentioned earlier on this point about changing. I suppose every investor's challenge is to change as the market changes. And one thing we've learned over the past 10 years is that for all the reasons we discussed, there's not necessarily, because the flip side is, and again, actually the one use of capital allocation we didn't talk about is simple liquidation or the takeover of the company itself. Yeah. Often I look at Deutsche Bank, which trades at 20-30% of book, and you kind of think, again, the classical textbook response would be just liquidate the company. And clearly these banks are too big. The flip side of them being big and having consolidated is they're too big to liquidate. And so capital gets trapped.
It's funny you mentioned Deutsche Bank, because one thing I was kind of thinking about asking you is, obviously, and you wrote about Wirecard about a month or so ago as well. Deutsche Bank, giant German bank, Wirecard, one of the biggest financial frauds in history. And it comes out recently that I think it was Wirecard was exploring a merger with Deutsche Bank, not the other way around, right? But I wonder, it's a super interesting thing, and anybody who's not really deep into, I think a lot of American listeners might not be as familiar with Wirecard as the European listeners, particularly people who don't really follow finance. Maybe you can dive a second into Wirecard, the Deutsche Bank saga, and kind of what you learned from that.
Well, that's really interesting. That's really interesting. And there's two components of this. One is the fraud component, and two is, just forget for a moment that it was a fraud. Here you've got a very high multiple, just wind the clock back. You don't know it's a fraud, but it's a high multiple. This was a company that wants to exploit its multiple to buy a company which was not very profitable.
Yep.
But whose assets were cheap. So this was a classical. I'll come back to the fraud in a second, but it's interesting because what you haven't seen yet is tech companies buy banks. Now I suppose they don't want to, because they don't want to get involved in all the regulation.
Yeah.
And we can talk about Ant Financial if you like, because there you've got a model which companies in the US and elsewhere are trying to replicate, which is to do the front end piece of banking and therefore be exempt of the regulation.
Yep.
Which is kind of back end oriented, to do the distribution of financial services where a lot of the margin is accruing. So there is that model. But obviously that wouldn't have helped Wirecard, because Wirecard was a fraud. And on that point, the only thing I would say is there was a great story. We're chatting on September the 3rd, and there was a great story in the Financial Times this morning, which is the first person tale of Dan McCrum, who was the FT journalist who kind of broke. He was onto this. I was reading his Alphaville posts on Wirecard back in 2015. He was onto this 5 years ago. And it's just an incredible story. Undoubtedly it's going to be made into a film. It's an incredible story of an investigative journalist's determination to reveal the truth.
Yeah. And
the pressure he was put under by the company, by the establishment, by some sell-side analysts is just, he starts that story in the Financial Times today, talking about the Commerzbank analyst and the abuse he got from the Commerzbank sell-side analyst around that. It's an incredible story.
Yeah. One thing, Wirecard, it's such an interesting story. And one thing I worry about is you can almost view it through, a fraud's a fraud, right? There's no positive light to view a fraud through. But the Wirecard story, people were saying it was a fraud as early as 2008, 2009, if I can remember correctly. And I remember reading some of the Alphaville posts in 2015, and the stock was up 12x since the first allegations of fraud, which were all completely correct. And then, regulators were pressuring the journalists and investigating short sellers over this. And it turns out no, this was a fraud. And I worry there are so many stocks I can think of right now in the US markets and everything where it seems similar, right? The stocks are screaming higher and the short sellers are screaming, hey, this is a fraud. And it's it's so easy to think of Wirecard for all of these different things. And I guess the other thing, similarly, these high multiple, high flying stocks why not go merge with a lower multiple stock to take advantage of your multiple. You know, people mock it, but this is what Teledyne did 50 years ago, and they were one of the best performing stocks of all time, right? If you've got a big multiple, go buy low multiple undervalued things, and that'll help you grow into it. And, you know, I think like a Lemonade, they trade for like 50 times book. Why not go use your stock to buy an insurer and get into the insurance, really get Tesla. Use your stocks to go buy Ford or GM and take over all of their engineers and stuff. I don't know if they even need it, but yeah, just stuff like that. Like, it's so interesting.
That's right. And we saw it. I mean, we saw it in the last cycle. We saw it in 2000 with AOL. So the precedent's there, sure.
And people mock that, but like, what would AOL stock, if they hadn't bought Time Warner at the time, like that actually kind of worked out great for AOL shareholders, right? So I know these deals are mocked, but actually, if you're the person with the high multiple, you can create a lot of value by doing this. You can almost save the business. And obviously, Wirecard was trying to save the fraud. Let's switch over to SPACs. So I've been obsessed with SPACs. You recently wrote a SPAC piece. You know, this morning we saw another SPAC deal. KCAC announces a deal to buy an electric battery manufacturer. Stock goes from $10 to $18. So maybe you can just dive in. You know, what is a SPAC? Why are companies going crazy for SPACs right now? And why is this interesting?
Well, I think it's interesting, and it comes back to this Michael Mauboussin piece as well, because he talks about this shift between private markets and public markets, and over the past 20 years, this fascinating development has occurred whereby public market supply has shrunk, number of companies has halved, the demand has increased. And on the private side, the number of companies, because the barriers to starting up a new company have come down so much, the number of new companies has just ballooned. And so you've now got seven, not just private companies and like, your mom and pops, but you've got 7 times as many private companies that are owned by venture capital or private equity. So not mom and pop, to every one public company. And it kind of occurred to me, my background is a public market investor, like you, public markets. But I mentioned earlier that I recently dipped my toe into private markets as an angel investor in fintech. And it kind of, I kind of creaked open the door into this market and took a peep inside. And it's a different market. I meet with venture capital folks and they, their background is, and certainly the companies that choose to partner with venture capital firms, in my experience, have prioritized those venture capitalists that have got an entrepreneurial track record. A lot of them are entrepreneurs. Yep. Now, the public markets, occasionally you'd come across a guy that used to be, an operator, and many of them make very, very good public market investors. But it's not a bigger as a factor in public markets as being kind of an entrepreneur is in private markets. Very, very different. It kind of feels as well that, certainly very, very early stage venture, and the venture capital method of valuation is all about looking to the future, whether it's TAM or whatever it might be, and discounting it back. Yep. Whereas in public markets, we kind of look to the we start at the present and we model forwards, or we look at the share price and we carve out a path forwards. We start at the present and we go for very, very different markets. And that's fine. And they kind of, they coexist. They've got different investors, they've got different companies, they've got different pools of capital. But they come together historically it was through the IPO. And my metaphor was kind of like the wardrobe in, the Lion, the Witch and the Wardrobe. It's kind of Narnia. It was kind of, on the one side, you've got, us public market investors, the humans, and you've got this wardrobe, which is kind of the IPO market. And you kind of go through into the other side. Actually, this is more SPAC, but you kind of go through into the other side. And actually, you literally have the unicorns on the other side in the land of Narnia. And what the SPAC does, and so, historically, you have to wait for the private market company to come to you. And they through the IPO process, and and I've kind of been involved in that in the past, both on the sell side, on the sell side where we roadshowed some of those companies. And on the buy side, obviously, I mentioned Visa before, which was an IPO a long time ago that we were involved in. And then you've got the SPAC, which is, it's kind of the opposite. Instead of waiting, the private company to come to you, you can actually send your scout in through that wardrobe to go and look in that world and bring one, bring one back out again.
Send them in with $200 million and have them just...
Exactly. So, in theory, there's some kind of logic to that. In practice, there's a lot of drawbacks, and I know you've written in your blog about some of those drawbacks, and there's a whole load of drawbacks. Obviously, it's difficult to create. Financial engineering, if you like, financial engineering tends to be quite a cyclical phenomenon, and to the extent this is a manifestation of financial engineering, it might reflect where we are in the cycle. But the root cause, i.e., there are private companies out there, and there's a lack of, and there's a demand for them in the public markets. The root cause maybe is credible, but some of the financial engineering may not be.
Yeah, so I'll just give a quick example. So, a SPAC is a company, they IPO and investors will give them $200 million, and the SPAC just goes hunting for a company to merge with, right? And if they can't find a company merge, the investors will get their $200 million back. And a lot of companies have done this recently. DraftKings came public through a SPAC. Virgin, it's space. What the SPCE is the ticker. It's the Virgin Galactic Space Enterprise did it. Nikola has been one of the most high-flying ones. And recently, investors have gotten very excited about these, right? These things have $10 per share in cash. They're announcing deals and their stocks are going from 10 to 15, 20. Nikola famously went 10 to 70. And I guess when I look at this, I see just awful incentives, right? They have to announce a deal or else the SPAC liquidates and the founders lose all their money. And B, I look and I see Nikola is the poster child for this. Nikola has no revenues whatsoever. And people just got really excited for an electric vehicle space. And I don't know about you, when I see this, I guess there's two things I think. The first thing is, do you feel like it reminds you at all of the dot-com bubble? People are coming without a business model and investors are just giving them billion-dollar valuations?
Yes, it does. But then, it does, but they sustain those valuations in the public market. So you could argue, somebody's exploiting someone, and that's always the case in a bubble. But I agree with you. I think some of them, I look at stocks historically where, I think at 0.3 times book value, there's value there. The market is not interested. It's interested in 30 times revenues rather than 0.3 times book value.
Yeah. I guess the other thing I've been thinking a lot recently, and I might have to write an article or tweet this at some point, but last year WeWork tried to go public and they filed their IPO. They got laughed out of the room, and it eventually led, WeWork was trying to go public at 50 billion and eventually led to the founder left. The whole company had to be restructured. The business model was not sustainable. And I think now WeWork's worth a couple billion or something. Who knows if they make it or not. They say they're profitable now, but WeWork collapsed because they couldn't IPO. And I wonder if today, if you could take that WeWork IPO, fast forward a year, if WeWork tried to do a SPAC, I wonder if a SPAC would go crazy for a WeWork deal, and if WeWork would have sustained 100 billion IPO and be on the verge of taking over the whole commercial real estate sector.
Well, so Matt Levine at Bloomberg wrote exactly that. He said he wrote a great article about SPACs. He said he never understood SPACs until WeWork. Our mutual friend Bern Hobart, he's talked about an option on hype in this sense, i.e., the advantage a SPAC has over an IPO is that you can do it very, very quickly. And so, if that's WeWork and let's do it so quickly that no one actually looks at the books, or whether it's, I'm not sure if fraud could get through, but certainly the scrutiny required, the bar is a lot lower, and stuff would get through that wouldn't have done otherwise. Buyer beware.
Well, you just made me sad because I thought I had a very original thought, and I read everything both Bern and Matt published, so it probably just burrowed in the back of my brain and came out as you were discussing it. You mentioned you're an angel investor in fintech. Maybe you could talk, What type of stuff do you look for in fintech, and how's that angel investing been going?
So no, so it's as I say, it's very interesting. It was a completely new market to me, and coming at it from the fin perspective rather than the tech perspective makes me a little bit unusual.
Mm-hmm.
And the way I thought about it, there are kind of 4 business models within fintech, and 3 of them are not that interesting, and one of them is. One of them is just a nicer user, a nicer front end. It's kind of very consumer orientated. A nicer. We'll go after millennials, and we'll have a better UX. And the first wave of fintechs were revolved largely around that, and many of them now still, that's a big piece of it. It's not Lemonade, which you mentioned earlier, is not entirely that, but certainly, there's a kind of story to it. The kind of Robin Hood story.
Yep. Get your renter's insurance in 2 minutes. Be able to trade stocks in 2 seconds in a friendly way. Yep. Yeah,
exactly. Well, actually, that's the second thing. The second thing is speed. So the first thing is UX. Second thing is speed. And that's the third thing is, which is less interesting, is regulatory arbitrage. So so Chime is able to grow so quickly because it's able to offer, because its interchange is higher, because it falls below the Dodd-Frank kind of threshold around interchange. There are tons of examples of companies in the US and elsewhere which basically, and they've emerged post-financial crisis. We were talking about regulation earlier, which are able to kind of arbitrage some of these regulatory loopholes. Whether that's sustainable, probably not.
I was trying to think of an example as you said it, but in my history, I found regulatory arbitrage, you can make a lot of money for a short period of time, but eventually either the regulators come on it or your competitors say, hey, these guys are making money, you need to close this loophole, and the loophole gets closed, and it generally ends up being a zero, sometimes less than a zero, because you have to pay penalties for exploiting the regulators at some point.
Exactly. But the final one, which is interesting, is kind of new, which is just new products. It's like stuff, it's not about, it's just stuff that couldn't have been innovated in the old banking system or in the old financial system. So whether that is, and often that can be linked to speed, because the financial system didn't have the wherewithal to, didn't have the infrastructure to offer that kind of speed. So, there are some examples around, some of the things I'm interested in, for example, are user acquisition finance. Mm-hmm. So there are some companies, there's a private company in the US, which I'm not involved in, but a private company in the US called ClearBank. Okay. And they do user acquisition finance. So a SaaS company or any tech, wouldn't have to be a startup, would come and say, look, these are our unit economics. We've got the data to show you how those unit economics look. And we know the return on investment, if we were able to acquire customers, is 4x, 5x. We want to borrow in order to exploit that ROI. And a bank doesn't know what we're talking about, and there are models evolving to provide that kind of financing.
And this is something Byrne, I believe you wrote about it 2 days ago as well, right? Like all these SaaS companies, they have to fund with extremely expensive equity, which kind of doesn't make a lot of sense. But a SaaS product is actually a natural for debt, as you're saying, right? Like it's a recurring cash flow revenue stream. How it really should be financed is, hey, we need to go spend $100 to get users. We should get $100 of debt to finance that because it'll result in $50 of cash in every year. And that's great for a debt product. That makes tons of sense. Yep.
Exactly. So I'm involved in, I'm an investor in it's a UK based, but their market is European, company, which does this for the gaming industry. So, okay. One of the features of COVID, obviously people are, just gaming's obviously. There's a whole
gaming like World of Warcraft or gaming like sports betting?
Like World of Warcraft.
Okay.
And exactly. So games, so typically, app-based games, where the company will publish a game, can see that the customers are ramping and wants to borrow to fund that customer ramp.
And they're basically borrowing to get Facebook advertisements, Twitter advertisements, to get app installs.
Precisely, exactly. So they know exactly. So they know exactly. So they know, and because the data, because Facebook and the App Store make their data available to third parties. We can see that traction in real time, and that makes it a very, very interesting kind of collateral to lend against. So that's one sort. And there's another company I'm involved in which does, and it kind of wants to, its kind of social mission is to stamp out payday lending, and one of the ways to do that is to provide employees with a drawdown on their salary. So
yep.
People typically get paid either on a bi-weekly basis or on a monthly basis. There are various solutions out there now, and this comes back to companies not having the infrastructure to be able to pay people on a
continuous
daily basis.
Yeah,
exactly.
Yeah.
But something Uber was obviously able to do with a different model, and there are various innovations out there, various solutions which kind of insert themselves between the employer and the employee, which kind of enable this. So salary finance is a big one. There's another one I'm involved in the UK.
Cool. And how are you sourcing your angel investment deals?
Well, so a lot of those are on network. So people, obviously, kind of 20 years in financial services, I've built up a network
A little bit of one, yeah.
Of contact. So a lot of it is through that. I saw Revolut, which is a UK based. They're now in the US. They've got 13 million customers. It's Challenger Bank. A little bit skeptical about their current valuation of these challenger banks, but I was shown that quite early. Kind of Series A, so it just kind of this network of just people are coming back to this being a new market to me as a public market investor. One of the criteria is is there somebody there that I trust? Is there somebody there that I know and that I trust? And so that's very important.
I think it was your last edition of the newsletter where you mentioned you were looking at the FANG equivalents of finance, and you said I think it was because the Goldman CFO, he said, "Hey, we consider ourselves the Google of finance, right?" And you said, "Hey, maybe Bloomberg is the Facebook of finance." Have you come up with any kind of other FANGs of finance?
Well, it's just a bit of fun, isn't it? I mean, I don't know. I was a little bit tongue in cheek. I think he was actually, what I didn't write on that post was that he was, and I suspect the biggest competition increasingly for Goldman in the recruitment market is Google.
I was going to say the same thing, yeah.
Right. So he clearly he's incentivized to try and, hey, when he goes to Harvard, which is where he made the presentation, hey, we're the Google of finance. But yeah, there are, it's a bit of fun. I think, I think in Amex is an interesting metaphor for, or rather, Apple is the interesting metaphor for Amex.
Yep.
With some, similarities there.
Yep.
Great brand, possibly slightly more affluent leaning, a closed ecosystem. Amex historically has presented itself as a closed ecosystem. So that's one. JP Morgan maybe is Amazon. They're involved both on the consumer side and the enterprise side. The the merchant solutions business, which is a fascinating business, is maybe a little bit like the AWS.
It's funny you say that, because you remember like 15, 20 years ago, Citigroup said they wanted to be the supermarket. Was it the supermarket of finance or something? So when you say JP Morgan is Amazon, the everything store, I think, oh my God, like the historical correlations there are not kind.
Yeah, no, that's true. But as I say, it's a bit of fun. Actually, your answer is really ant in America, in China.
Yeah.
I think if I look at the US companies that are most closely aligned to ant in terms of replicating it, it could be Square. But ant has basically done the job of aggregator. It's interesting actually. So Ben Thompson, who writes
Strategic.
I did a search on Stratechery to see what he's written about fintech. He doesn't write about fintech that much. And actually, he read a post in 2016 when Lending Club kind of almost collapsed. When the CEO of Lending Club was kicked out, there was a I don't know if you call it fraud, but there was kind of a big ethical issue they came up with, and the CEO was ousted. And he kind of then used that as an opportunity to talk about fintech, and he talked about whether fintech really lends itself to aggregation theory, which is his big theory about platform companies. And he said no, because because in the case of Lending Club, you've got your borrowers on the one side and you've got your savers or your investors on the other side, and it wasn't clear, which they were aggregating.
Yep.
With Ant, and he hasn't written about this, I don't know why, but Ant is very, very clearly aggregating, financial service customers, and it did it.
Go ahead. Sorry, I didn't mean to interrupt.
Yeah, and it did it through the way Square is possibly doing it with Cash App. It did it through a payments mechanism that wasn't by itself very profitable. All of the value accrued to Alibaba wasn't profitable. Its kind of net take rate is a basis point right now, but it was sticky, and they got consumers into the ecosystem. And once they were there, they were able to offer other financial products. And this is the supermarket analogy. It's not there. They started by doing their own financial products, and they realized very early on that regulation would come down too heavily if they were to do that. So now they have a panel of banks and a panel of insurance companies, and their take rates are pretty high. It shows you how much of the value. One of the interesting things about banking is that a lot of industries have become modularized. Banking is one of the last kind of vertically integrated. Mm-hmm. We were talking before about the branch. The same company owns the branches. It does the whole stack, and it's one of the only industries left that kind of does that on a vertically integrated basis. And one of the reasons is a lot of the value is at the front end. It is at the customer end. And so Ant has kind of recognized that, and that's what it's doing. And right now,
I can't wait for someone to write a book on Ant, because the history is fascinating. Like Alibaba literally they own Ant and it's stolen from them, right? Or they steal it from their shareholders. Ant at one time, as you said, they aggregate their money market fund, grows so big. I think it's got basically all of the money in China, and the regulators have to crack down. It has so much money. It's just a crazy story. I'm going to run one comparison by you. If I told you Robinhood, if I said Robinhood, and I debate about this a lot, do you think Robinhood is the Tesla of finance, or do you think it's the Netflix of finance?
What way? How is it?
It could be the Tesla because it's got a sleek app. It's beloved by retail investors. And I think the back end might be a little spotty, and there might be a little bit of security issues with it. It might be skirting some regulations, which I think all would be fair to say that all of that would apply to Tesla. It could also be the Netflix, just because, and Robinhood is hated by institutional investors, loved by retail investors. It could be the Netflix because I think a lot of people don't understand the economics of it. And, people look at it, hey, they give away free trades. How do they make money? Netflix, they burn cash. How do they make money? Well, they're making money. It's just values accruing in different ways. And because, Robinhood, I think a lot of investors are doing it more for entertainment than actually for long-term investing purposes. Though the way all the Robinhood stocks have performed, they might be doing it for long-term investing purposes. So which do you think it would be?
Yeah, look, I mean, I'm a skeptic. I think I'm a skeptic. I'm a skeptic of Tesla as well. I suspect there's some similarities between the two there. And this idea that, just the name Robinhood, this idea that this was, so they don't file financial statements regularly enough. They do file a balance sheet once a year because they have to as a regulated broker. Mm-hmm. If you look at the trouble is that the last filed balance sheet was end of 2019, and if you look at it, so it's kind of out of date. It's pre-COVID, and it's just a balance sheet. But if you look at it, they're doing a lot of margin lending. There's a lot of margin lending that's going on in there, and this idea that they are stealing from the rich to give to the poor.
Yeah.
certainly it's come under a lot of scrutiny anyway, given the behaviour of and the demographic of their customer base. But I'd love to see their latest balance sheet. Put it that way.
I'm just surprised, because they had the issue where a lot of their users were able to use, they called it the unlimited margin hack on Robinhood. And I just can't believe that that issue got discovered and publicized and that the site was still allowed to operate. I'm not trying to be too old funny, but that's literally how you get like stock market crashes, right? People use unlimited margins to take wildly outsized positions. And then the moment that a stock dips down, mass liquidations. And I can't believe that happened, and regulators kind of didn't step in and demand a lot more than a pound of flesh from them.
Yeah, look, and it's interesting. I think, and again, having looked at fintech and looked at financial services, one of the features is that there is a window. It comes back to the regulatory arbitrage point. Mm-hmm. There's a window whereby, firstly, regulators tend to be slower than the market.
Yep.
And, when the market's in kind of hyperdrive and things grow as quickly as they're growing, it takes a while for the regulator to catch up. And secondly, there's a point below which the regulator is just not interested.
Yeah.
It's too small. Now Robinhood right now is gone above the parapet on both of those. So I suspect, the regulatory risk is increasing, and that's not a linear increase.
Yep. 100% agree. 100% agree. Last question I ask everybody on this podcast. Anyone else you'd recommend for the podcast or anything?
So there's a few guys. I've loved a number of the guys you've had on already, and and well done for doing this. This is a great project.
No, you included. Everyone on here has been super sharp, and I've kind of been lucky to have them. So it's been a great experience so far.
But there's a few guys you may know them. So Scott Miller is an investor that I think very, very highly of.
Yep, over at Green. I can never remember if it's Green Haven or Green Road or Greenwood, because they've got all those. Yeah. He's Green.
Yeah, actually, it's a good point about Greenwood. Yeah, so it's Green Haven Road. I'm an LP. My kind of disclaimer: I'm an LP in his. He runs a partners fund.
Yeah.
Another investor that I think very highly of is Fred Liu of Hayden Capital. Again,
Hayden's been fantastic. I love their letters. We've exchanged emails, but yeah, he'd be great. Yeah,
he's fantastic, and there's another one who's kind of my neck of the woods, London-based, Marc Walker, Tollymore Capital, who's very, very thoughtful. He writes great letters as well, actually. I don't know if he makes them. I don't know if he's on Twitter even, actually, but he's big on content, and he makes his letters available, and he's a very interesting investor, also coming from the value school, but who's looked at.
I think I've read some of his letters before. Yeah, I can definitely reach out to him as well.
Yeah. Cool. So, but keep it going. As I say, this is a fantastic project, and I've loved all of the shows you put out.
Cool. Well, hey, I appreciate it, Marc. Net interest is great. I'll be sure to include a link in the show notes so everybody can go subscribe. It's a free product, and I love it. So I think everyone who listens to this will love it too. And Marc, thank you so much for coming on.
Great. Thank you. Thanks.